Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 229th VideoCast podcast for the week ending March 7th, 2024. Want to, first of all, thank everyone for all the beautiful, kind messages, emails, text, phone calls, emails, etc. last week. It really helped me get through, difficult period. And now we move on to the family updates for this week. Had the privilege to take Mimi and Annabelle to the Princess Ball, which was just an incredible time. That's Mimi and Annabelle and me in their dresses. They're looking like princesses. That's them on the dance floor. That's before we left in our foyer, and Mimi is wearing her grandmother's fur coat, so she was pretty excited about that. That's the girls there. That's before we left. Picture of me and Mimi and Lucky and Pepper in the kitchen, and that's me and Mimi. That's the girls on the dance floor again. That is Mimi at Pennsylvania last weekend. She played the Dare to Dream water polo tournament last weekend, and she scored 5 goals in 4 games, had 3 assists, and won every swim-off, which is pretty exciting. The coaches were amazing. The team was amazing, won 3 out of 4 games, and that was playing mostly against boys' teams, which was awesome. And then Annabelle was back here, went 221.80 in her 200 back and won the 12 and under mixed regional championship by 14 seconds. Just to give you an idea, 12 and under, she's 9. And then, Annabelle swam and made it to the Princess Ball with wet hair just in time. So pretty exciting family updates this week. That's the girls there before going on. Then I had the pleasure of going to be on the Clayman Countdown with Liz Clayman. This was out front in front of the News Corp building, for those of you who are newer. Then I had got to have dinner we'll go into that in a second. This is the green room. I like to take these behind the scenes photos because a lot of the newer viewers, this is actually at the set in studio. That's the great Liz Clayman behind me. That's the desk we sit at. This is the entrance going into the studio. And then this segment was great. I was on with a gentleman named Steve Liapi from BlackRock. We're going to listen to this segment, and I think you're going to sense an important shift in tone that you have not heard from me in a year and a half. And I go into it with Liz, and then I go into one of my favorite turnaround Tom picks. So we're going to listen now.
6%. So let's get right to the floor show, because we've got a lot of moving parts here. Joining me now, BlackRock's global co-head of fixed income ETF, Steve Lapley, and Great Hill Capital chairman Tom Hayes, who says, you know what, it is possible to brace for a correction but still be bullish. What do you mean by that, Tom? How do you do that?
Well, Warren Buffett had a famous saying. He said, beware of geeks bearing formulas. And the narrative of the market for the last 2 months has been AI and Bitcoin. Well, AI is going to change the world. It's just not going to do it by next Tuesday. The market is up 16 out of the last 18 weeks. We haven't had a 2% correction in 87 trading days.
A measly 2% correction?
Measly 2% correction. So last week and a half, we were on the network for the first time. And I've been bullish for the last year and a half, even when it was very, very lonely. We did put a portfolio hedge on, index put spread, to dampen volatility and to give us some excess capital if we get a 5 to 7% pullback, to get long and constructive into year end. So we are constructive, we are fully invested, but now we are hedged for a normal seasonal pullback.
Well, you initiated a tactical short. Give that to our viewers in plain English.
Yeah, so we went out a couple of months. During the election years, February, March, April tends to be a weak part of the season. We've run up quite a bit. Earnings are good, but we're trading at 20.5 times forward earnings. That's a little rich. How we expressed it, a little bit out of the money S&P put spread. So you buy the near strike price and you sell the lower strike price. So if the market moves, that 1% of equity capital If the market pulls back 5 to 7%, we make 5x on our money, which gives us nice portfolio dampening.
Steve, we had a lot of equity records. We also had some pretty significant bond records, at least certainly year over year. When you look at the record when it came to inflows into bond funds, $300 billion, $203.7 billion of that was here in the U.S., and you guys got a huge chunk of that over at iShares. Does that continue, and in what form?
Yeah, I think we're pretty bullish on it because if you look at the landscape today, we're at yield levels that are greater than they were 20 years ago, which I think is pretty remarkable. And so there's tremendous opportunity in the bond markets right now. So we saw investors deploy over the last 2 years. You know, granted, some investors were early. We did have that run up to 5%, but now, as we could see even from today's price action, you know, we've retraced. We could probably be sideways here for a while as everyone sort of sorts through what the Fed's posture is going to be. We're going to get more information on that this week. We're going to get more data coming in. But we're very bullish on the idea of upping your fixed income allocation. We think investors have been fairly underweight fixed income even after these flows. So we think there's a lot of room to run.
Okay, so what is the best actual trade if you were trying to look at the yield, considering also the current potential upside valuation gains as rates fall? I mean, this is a lot of cross currents your investors have to be faced with.
Yeah, there are a lot of macro factors that do need to play out. You have to have a view. So if you're in the soft landing camp, then risk assets are attractive. So even at these tight spread levels, high yield offers excellent carry.
What if I'm in a hard landing scenario?
If you're in a hard landing scenario, you want high quality duration. So that can mean long dated investment grade or even more long dated treasuries.
How long? 5, 7?
Well, we saw a lot of flows go into TLT, our 20-plus fund, last year. We saw over $20 billion go into that fund. So we'll see if those flows pick back up again.
Well, again, just because the herd is doing one thing, Tom, doesn't mean that each investor has to do the same or follow that herd. What are you doing differently beyond what we've just talked about?
As you know, they call me Turnaround Tom for a reason. We like dramatically out of favor companies that are high quality companies. So one is Advanced Auto Parts, which actually got upgraded today. The CEO, Shane O'Kelly, he came from HD Supply, which was a $7 billion business for Home Depot. Advanced Auto Parts is down 70%. He's been in for about a quarter. Before he could even find the coffee machine, he took $150 million of costs out.
He's one of those.
He's one of those. He's selling off the Canadian business. He's going to delever the balance sheet. He's going to simplify the supply chain and distribution centers. And he took guidance up in his first quarter. He took earnings guidance up 10%. And he said we're going to have at least $250 million of free cash flow next year, which is critical in a turnaround situation because you need the runway to get the turnaround in place. We talked about it on the network in the mid-50s. It's now up over 70. We think this can go to triple digits over the next 12 to 24 months.
Well, really quickly, Steve, Jay Powell is speaking tomorrow and then Thursday. What are you expecting from him, and when are you expecting the first rate cut?
I think what we're expecting from him baseline is he's going to reinforce this narrative that they can be patient, they can continue to watch the data come in. The market's pricing that in. You know, Tom and I were talking before the show just how it's shifted. We've shifted from, you know, as many as 6 cuts to, you know, a little over 3.5 at this point. I do think the market's sort of centered on, you know, around June. So we'll see if that plays out. But I think he's more than likely going to reinforce that message. Okay, guys, we got to run. We are now very close to session lows, particularly with the NASDAQ. The NASDAQ session low, new one, 329-point loss. We're down 324 points. Steve, Tom, always good to see you both. Thank you very much. You know, it may seem...
And we're back. And as always, want to thank Liz Clayman. Liz gave me my first break on TV, by the way, 4.5 years ago. So I always love going on with Liz. Forever grateful to her. And of course, the amazing producer, Catherine Myers, who's been great as well. This was a dinner on Tuesday night. All the guys were in to do Fox. Kenny Polcari, everyone knows. Kevin Mann, Mark Tepper, Adam Johnson, Lou Bassanese, John Lonsky, Ivan Feinseth, etc. You'll see all these guys on Fox. A lot of them do Mornings with Maria and Varney and Cavuto. And I do mostly Charles Payne and Liz Clayman on the Clayman Countdown. But broad spectrum, great dinner. Steak, my favorite, as always. Also, want to mention real quickly, next week, the end of the week, I will be in London. Large family office is hosting me, and I'll be with them all day on Friday. But on Thursday, I will be available for lunch or dinner. I'm staying in the Mayfair district near Hyde Park. Also on Saturday, I'll be available for breakfast or lunch. So just a quick 3-day trip. And for potential clients that want to get together and grab a bite, that would be fun. Also want to thank Ellen Chang for including me in her article on cheddar.com. That one was about Meta. And our quote of the week to kick us off from John Templeton, the legend: to buy when others are despondently selling and to sell when others are euphorically buying takes the greatest courage, but provides the greatest profit. And this week, we did a bunch of both. It's a unique market. And as I shared with Liz and also last week with you, we did put a 1% of equity capital with an expected value of 5x hedge/tactical short across the portfolio. Today, we did more. We actually added another 1% of equity capital short on a specific subsector. And if you read our article of the week this morning, and we'll go through it today, you will be able to reverse engineer which sector that was. The expression is reserved for my clients, but you'll get a lot of value there. The other thing we did is we did take some money off the table with not stock, but with options that have run up, 3, 4, and 5x. Some of the tech options we took off, believe it or not, some Amazon options. We kept all the stock, but some of the options were up many multi-baggers. And we didn't take any Google off. We took off, there were a few sets of options we took off. So we raised some cash in the portfolios. We're still largely fully invested, but we have 2 major hedges on with expected values between 5 and 10x. So if the market pulls back the way we think it might in the next couple of months, those hedges will make us a lot of money to put to work. And if they don't, we're still have any stock that hasn't reached full intrinsic value is fully invested as normal. And we did find some great opportunities to go long as well. So this is really where the skill set comes in and the opportunities. But my guess is we're probably a week or so early on these tactical hedges or shorts. But I think that I'm seeing all the signs that I need to see that it creates an opportunity. I mean, I don't expect anything material. I think it's going to be 5 to 8%, maybe 4 to 8%. But you can make a lot of money in those environments. You could also just sit through them and don't worry about it. But if I can create an extra 10 points of alpha this year, and maybe more than using that capital long into year end, now that we have 2% of equity capital now leveraged short, that could be pretty awesome going into year end. So wanted to do that for clients, and gives you an idea of my mindset. And if I'm totally wrong and the market presses higher, the beta in the portfolio will outperform it. And if the market's up another 5%, the beta would probably be up 8 or 9, and then you subtract out the 2 for the hedge, so net 7. That's okay too. But that's not our primary framework, but we have to account for that. Some research here from Bank of America. First off, realistic bull bear case. So they give a range between 4,100 and 6,500. Not terribly helpful. They say sentiment is euphoric on AI and GLP-1, but not much else. Interesting thing about GLP-1 is that you're seeing more and more and more companies every single day get approved with amazing GLP-1 drugs. So the old saying that Jeff Bezos is famous for, your margin is my opportunity is now playing out in the GLP-1 sector, and in a matter of 12 to 24 to 36 months, provided the drugs continue to work and have no material side effects, which is looking better and better each day because many of these have been used for 20 years for diabetes and such. There will be many more entrants, and there will be a lot more pressure from insurers and users to lower and governments particularly to lower the costs. So those first movers that had an edge, those opportunities are going to be eroded, and the models of every overweight person in the world using them and paying full price may have been a little bit too aggressive. Why am I spending a minute on that is because the same exact scenario is going to be the case with the AI hype stocks. If you think NVIDIA is going to be the only chip producer to have specialized GPU chips that can process this stuff for the hyperscalers, think again. More entrants will come. It will become commoditized, and the sector will be cyclical as it always has since the dawn of time. I think the phase that we're moving into, where the real money is going to be made with AI, and like I like to say, AI will change the world, just not by next Tuesday. And it's priced in as if it's already happened in some of these specific subsectors and individual companies. I think the second derivative is going to be the story for the Roaring 20s is going to be greater productivity powered by AI and other efficiency tools. And what you want to look for is the companies that do not have existential risk from AI that will actually utilize AI, and the net effect will be ever increasing productivity, and margin expansion is going to be the name of the game for the second half of this secular bull market that started, call it 2013, and when we broke out to new highs after basically 13 years of going nowhere. So that will be industrial companies, that will be it could be banks, it could be many of the company, supply chain distribution efficiencies. Think along the lines of the Generacs and the Stanley Black & Deckers. They look like boring old businesses, but when you add this technology and they can do a lot more with less, people are still going to need tools, even if they're robots. And I think that's where we're going to get the tailwind. If you look at the original Roaring 2020s with something like 500 car companies, and most of them went bankrupt. The boom was manufacturing. It was the whole theme. It wasn't just one particular sector. It was the technology that spread across sectors, mass production, et cetera, et cetera. So very excited about AI, but not where everyone is looking. Everyone is looking for a handful of stocks that are the AI winners, and they're going to be, they'll do fine, but the real value is going to be where no one's looking yet. Market pullback likely, but so is year-end rally. I agree with that. They took their price target up. Everyone started taking their price target up. Why? Because their original price target has already been exceeded. This is the normal thing you see when you're due for a short-term pullback. Other important factors in this, the gap between the Magnificent Seven is narrowing. The earnings power of the Magnificent Seven and the rest of the market. So that's a sign of health, the broadening. And I think we could see an environment, because there has been a lot of places to put money to work. I've had new money to put to work in the last couple of weeks and days. And while we still have, and we raised cash across accounts, but there are still plenty of places to put money to work now, even though the general indices are, I believe, short-term frothy and due for a pullback. Under the surface, that the companies that have very low weights are not even in the indices, I think could find themselves actually taking off even if the general market is moving against the tide in the short term. I think you're going to see a rotation. So, and basically with a market cap weight index like the S&P, a pullback just means that the heaviest weights are taking a breather. The heaviest weights that control, that have the highest attribution as far as the general indices gains, those are the ones that we could see most weak in the next, call it 8 to 10 weeks. And under the surface, those that have a very insignificant weight or no weight in the indices could be doubling and tripling, or moving up materially, 30, 40, 50% moves, even if the general indices are weak. So just keep that in mind from a sector rotation point of view. And we've talked a lot about those sectors. As it relates to the overall, this is their equity sentiment. It's not at an extreme. So, I mean, I'm very bullish and constructive for the year, short-term cautious, but we're not at extremes. Hedge funds are still defensively positioned, overweight defensives relative to cyclicals at an all-time high, which is why I think cyclicals can start to run. And cyclicals have a much lower weight than the heaviest weights in the indices. That's why I think the indices can slow down, and these other companies can start to move. And this is evidence of it right here. Okay, that's all I wanted to cover from that note. Next thing is the year-over-year earnings growth of the Russell 2000 has turned positive for the first time since September of 2022. This is a core theme for this year. We think small caps can start to outperform. Powell actually tipped his hat that he is going to cut this year. He was slightly less hawkish than I thought he would be, which is good. And that is absolutely critical for the small caps and regional banks with the mark-to-market. And we had a huge breakthrough with the regional banks with Steve Mnuchin, probably best public servant who's ever served in the history of the United States, saved us from a Great Depression during the pandemic, architected the entire backstop of the corporate credit markets. Otherwise, we would have been in an absolute depression with the world shut down. Probably saved the world. Let me just understate everything he did. Anyway, he just stepped in with $1 billion for New York Community Bank. He got a sweetheart deal, massive dilution, massive warrant coverage. So effectively, the stock had historically been at a $13 all-time high. With all the dilution, assuming the business gets back to hitting on all cylinders over the next 12 months, and Powell cuts rates and the mark-to-market improves, your upside would be to $6 here, probably not to 12 or 13. Although Mnuchin will make the business better, so maybe you get $8. But if you're thinking it goes right back to 13, think again. He got $1 billion of equity in at $2. Which it barely even ticked during the day. But, they had no leverage power because they could have let him go. And that's just the way bank confidence works and the way Steve Mnuchin works, because he's one of the best out there in terms of mental horsepower. Let's just put it that way. So discounted small cap stocks poised to outperform large caps. We agree with that. Forward PE. This is from Wolf Research. They're comparing the bubble of the late 2000s versus the current. And what you can actually see here is we're not in a bubble. And that's why I don't think we're getting a major correction. That's why we're largely fully invested, although we raised a bunch of cash and put on another tactical short in Hedge today. You look at multiples of technology today, 28 times versus in March 2000 at the peak, 48 times. Healthcare was 24. Right now it's 18. Discretionary, we're trading a little bit higher now. Industrials was 22. But remember, no one wanted industrials in the late 2000s. Comm services, that's actually a new sector. I don't even know how they did that comp. Staples is a little rich right now relative to 2020, relative to 2000. So there was less demand at the top. So it's just showing, yeah, there's a little froth. 21 times forward earnings is rich. That's why I think we could get a little pullback here. But if you want to compare it and do all those analogs that you see all over the internet, don't waste your time. Goldman raises 2024 buyback projections, unveils 2025 forecasts. So we're going to have record buybacks. We covered Mnuchin. Ford sales jump 10.5% in February, led by gains in hybrids and EVs. That's counterintuitive, but volumes are the name of the game for what we need with Cooper Standard, which is great. And, it's interesting. Tom Lee was out saying the upcoming inflation report could spark the market's next big sell-off. Fundstrat says, I don't know if it'll be that, or if it'll be the jobs report tomorrow, or if it was, I think Marvel and Broadcom were a little weak. Semiconductors, by the way, hint, hint, after hours. So I think irrespective of what is the cause, the key is, in the short term, are we going to run out of buyers? And I think over the next week or two, the answer is probably yes, short term, but not buyers for every stock. It's not wholesale. There are things I'm buying because they're at the right level. But the things that have run a lot and are at or near fair value, we certainly took off some options that were up many multi-baggers, but kept all of the stock. So that's what he thinks. And his view here is that he says, quote, to us, this is also the decision point for markets in 2024. If the February CPI is hot, even if for statistically wrong reasons that we agree with, we think the markets could become anxious. And I agree. I don't know if that's going to be the catalyst or not, or if it's going to come before, or if it's going to come after, or there has to be a specific catalyst, but it just stood out. Mikhail sent this to me. I saw the headline this morning, but I didn't read the article. It was about Temu and Pinduoduo. This was interesting because you'll see when people have asked me about Pinduoduo in the past, this falls right in line with what my response was. But this is from the Financial Times, and quote, Temu's sister app Pinduoduo already dominates China. When it still published such numbers, PDD reported more than 870 million active users in the country, supplied over 13 million merchants who, it claimed, quote, together generated a third of all parcel traffic in the country, tens of billions of packages per year. After just 9 years in business, PDD is now bearing down on the world's biggest e-commerce group, Alibaba, both in terms of retail scale and stock market capitalization. Worth $162 billion, it regularly trades places with the older retail giant as the most valuable company listed on a U.S. stock exchange. But the tale told by those incredible numbers is a mystery that raises more questions than it answers. For instance, why does PDD look like much smaller peers when staff levels and research spending are compared? Why haven't competitors described the impact of Pinduoduo's rise? Why do balance sheet metrics move at a different pace to revenues? How does a $200 billion company own less than $150 million of hard assets? These questions add up to a bigger one. Why do U.S. investors have so much confidence in an opaque operation whose financial statements seem to lack much pattern or explanation, and whose operations, management, auditors, and regulators sit in a distant, untouchable jurisdiction? A PDD spokesperson said, quote, "We respectfully disagree with that characterization. They encourage the Financial Times to, quote, review our financial reports and earnings calls for comprehensive insights, and said, quote, disclosure rules and fairness principles prevented it from commenting on those financials to individual media outlets. The American stock market is scattered with cautionary tales of Chinese promise that ends up unmet. Quote, I drank a lot of coffee in a lot of Luckin coffee locations, and it was still a fraud, says one investor of the once $13 billion NASDAQ stock, which admitted to inflating sales figures in 2020. Wish, an algorithmic Temu-like e-commerce site saw a 22 billion market value dwindle to almost nothing. Yet few have promised as much to investors as Pinduoduo. It operates like eBay and Amazon's third-party marketplace, connecting buyers with sellers to take a cut of each transaction and charging merchants to advertise on its platform. In its most recent quarter, those revenues almost doubled versus the previous year to 9.4 billion, prompting Alibaba founder Jack Ma to exhort his former company to, quote, change and reform in response. Pinduoduo reported 2.5 billion of cash flow, even as it appears to throw very large sums at the expansion of Temu. It has achieved this with a headcount count that upends all assumptions about e-commerce logistics, meaning the packages are magically walking themselves to the customer. That's my editorialization. It started last year with 12,992 employees, an order of magnitude less than Alibaba and a small fraction of Amazon's 1.5 million staff. So Pinduoduo, can rival the biggest of the big that has 1.5 million employees with, quote, 12,000 employees. Yeah, that adds up. Pinduoduo's physical footprint is also minuscule, a striking contrast with Amazon, JD, or Alibaba, where control of logistics was long seen as a competitive advantage and a way to ensure speed, capacity, and satisfactory service. Alibaba spends $5 billion a year on property, plant, and equipment, including the upkeep of 1,100 warehouse. Pinduoduo owns just $146 million of hard assets, mainly office equipment and IT hardware and software. Look, all I can tell you is, as I've said on every single conference call, I wanted exposure to emerging markets, and I wanted the highest quality for when the dollar weakens and the Fed gets out of the way, and I wanted the highest possible quality company in China. And I chose Alibaba because it had the most outs. Number one, it was proven for 20 years. The odds of it being a fraud, you buy any mid-cap or small-cap company in China, you got a 50-50 shot it's a fraud. And that's, a little bit of exaggeration, but not much. So I wouldn't touch it with the 10-foot pole, no matter how good the numbers look. Pinduoduo came out of nowhere. This reminds me of VIP shops years ago when the shorts destroyed it. This report raises more questions than answers, and the amount of vetting that had to be done for Financial Times to go into this level of detail tells me that this may be a paper tiger and or paper dragon, more aptly put. And I think we're going to find that good old Alibaba is the name of the game in China and on the e-commerce, and we already know that for the cloud. So there we go. I like this article in the Market Watch. Nervous about the U.S. market at all-time highs? Buy China stocks. We couldn't agree more. And they go into the valuations and the opportunities, which we've covered ad infinitum. China needs forceful measures to hit their 5% GDP target. Funds say they're coming out with more stimulus. That's good news. They set their target high. That's good news. They have confidence. They hint at a liquidity boost. They cut rates again. So it's all adding up. It's just going to take longer. Someone actually asked a question. I'll deal with it right now. For the AMA section, they say... basically, Sam R. asks, what policies does the CP need to do in your view? They have pumped in a lot of liquidity already, housing specific only, or does it not matter? Thanks. They're already doing the old playbook in housing, so that's going to be fine over time. Look, a lot of it has to just catch up, but I think that they could take a page out of the playbook from the West. We've all recovered. They've lagged behind. The answer is maybe some direct stimulus in the hands of the consumers to give them back confidence. I think $500 billion would be the right number. Massive action. They could probably get away with $250 billion. Just light the spark. I mean, what I would do in their shoes is do a debit card with a 30-day expiration. They have to go out and spend, get the action going, get people back in the mode, put money in people's pockets. and just get things going. I don't think they'll do that. I think there's enough in the pipe that it'll just, it's just going to work its way through the system. Fed will step out of the way. People will start to look at relative value, and the game will be back on. We saw a hint of it with JD this week, and I think we're going to see more of that to come. China's exports and imports beat estimates for the first 2 months, signaling improving demand. So you're already starting to see the things we want to see. Why China's property downturn has a silver lining for consumption. So they go through all the data, the savings, and the lower cost of housing now, and China's mortgage rate have been cut to record lows. So they're taking the steps. They're trying to do it in a sustainable way versus all at once, and we'll see how that goes. So, all right, tool time stock market and sentiment results. We covered the Clayman countdown. Thanks to them. You can go through the show notes. I went into some more detail. Yes, we're short-term cautious, but don't get too cute. We're just breaking out of 2 years of no returns. I think the likely outcome is we go back and retest. Small caps, however, look like they're just breaking out. So what if we had a retest on some of the tech or subsectors of tech, and at the same time, small caps showed some strength? That would be interesting. Biotechs are breaking out. So a lot of good things happening. Sentiment still despondent, but starting to recover. Which supports long-term bullishness. Okay. I've said for 1.5 years, every week when people would wonder about the latest negative headline or commentator, quote, I'm finding a lot more great companies to buy than sell. As you saw in my commentary above, that equation has shifted. I'm by no means bearish, but I think we will see some weakness in coming weeks and months, even if we go a bit higher first. I will never discuss individual shorts, but a reporter from Bloomberg reached out last night to ask whether the rally in AMD was sustainable. We have no, at the time of this writing, we have no position long or short. That can change, by the way, since writing or not. But here's what I had to say to the reporter. And you can imagine this is a proxy for a number of other popular high flyers and grouping as well, which was, dear blah, blah, blah. Free cash flow is rolling over while price continues to climb. Return on invested capital is declining and lower than its weighted average cost of capital. The market can stay irrational longer than you can stay solvent, but this is a formula that tends to end badly, even if it goes higher before coming back to earth. At that point in time, I had no position long or short, and I have no comment either way. Due for a breather in coming months was my view. I'm just, in terms of shorts, my general preference is to do indices or subsectors. On occasion, I will do discrete companies, but that is not generally the most efficient from an implied volatility standpoint if you're expressing with option premium. And when it comes to shorts, I like to contain my risk because you're swimming against the tide is really what you're doing. And that's why we do them in such a small asymmetric way when we get very large multiples on very small amounts of capital if we're right, and lose very little if we're wrong, and be able to stay fully invested. You contrast this with the type of companies we own that have a large margin of safety and are growing or inflecting free cash flow. And if you've been around long enough, you know a shift is coming. The last shall be first yet again. Speaking of which, each week we try to cover one or two holdings or companies we have covered on previous podcast VideoCasts. This week we're going to do Stanley Black & Decker's update. You can see the long-term chart here. Okay, so their transformation supports improved profitability expectations in 2024. On track for expected $2 billion run rate savings by the end of 2025. Their full year cash from operating activities was $1.2 billion and free cash flow of $853 million. Inventory reduced by $1.9 billion since mid-2022. So this is the same story we've covered a million times. Generac, Intel, Stanley Black & Decker, you name it, Canada Goose, VF Corp, they all overordered. They're working through their inventory. They're all near inflecting, and the game is on. You're seeing it in their free cash flow, and then the whole thing will turn. The other thing that they did that was mind-boggling, and here's a company that everyone's saying it's the end of, with $15 billion of revenue and $1 billion of free cash flow, and people can't can't figure out how this thing will ever turn around. I mean, you can't make this stuff up. Why? Because they know the price of everything and the value of nothing. And that's a sure way to keep chasing shining objects at the top and keep blowing up and rinse and repeat. And people just never get it. They have to chase what everyone else is chasing. It must be something in the vast majority of human DNA. And there are these few oddballs like me who and a number of you who listen, obviously, otherwise you wouldn't keep tuning in if you didn't have the same genetic, I don't know if it's a defect or an attribute, but over the long term, it's an attribute. Sometimes in the short term, it feels like a defect, but I can assure you it's an attribute for sure. Leaving that aside, fourth quarter gross margin was 29.6. That's up huge. I think they were down in the mid to low 20s a few quarters ago, and they're going to revert back to 35%, which is their historic high watermarks, and they're well on the way to do that. They sold a non-core business in their Stanley infrastructure for $760 million of cash that they'll use to deleverage. They guided adjusted EPS for next year, $4 a share mid-range, which is huge, up from where they are, which is negative, and then $700 million of free cash flow midpoint, and they're going to get less benefit from inventory adjustments than they got this year, so that's actually real free cash, which is pretty exciting to see. Prioritization of cash flow generation of inventory and inventory optimization. EBITDA was up 620 basis points year on year. Gross margin was up 280 basis points sequentially, which is really nice to see. They'll generate $1.5 billion of pre-tax run rate cuts by the end of this year and $2 billion by 2025, mostly ahead of their savings target for full year 2023, and achieved $835 million run rate savings from lower headcount, indirect spend reductions, and supply chain transformation. So there was a lot of good news in this report. And the most important thing I think you need to see is the free cash flow inflection. And this is what a turnaround looks like. And the price will start to follow that as we get follow through in free cash flow generation. You can see their heavy duty line of concrete solutions debuted at the World of Concrete. So if those of you who are interested in the Inflation Reduction Act spewing hundreds of billions of dollars into the economy over the next 12, 24, 36 months, pay attention, because a lot of these tools are going to be in high demand by professionals. We covered that. We covered the margin expansion. We covered the cost cuts. We covered the free cash flow. We covered the divestiture and the deleveraging. Covered the guidance. We covered the liquidity. They've got $3.3 billion of liquidity. That's another great thing. Usually with turnarounds, that liquidity gets a little tighter. In this case, they have ample liquidity, ample free cash flow, ample revenues, unbelievable brands in DeWalt, Stanley, Craftsman, Club Cadet, and Black & Decker. So they're guiding flat on the revenue and up on the bottom line, up on the margins, solid on the free cash flow. And that is because a very conservative guide on home building. I think that might be the white swan that's not anticipated, because I think the minute people sense that the cuts are real, and the first cut comes, whether it comes in May, it comes in June, comes in July, at this point, it really doesn't matter. The economy is strong. I think you're going to see a race to the market. I think you're going to see a big flood of supply of houses back on the market. The game is going to be on. The builders are going to be back, and these guys are going to benefit. And once you see that activity pick up, then you got like people getting houses ready to sell, people rehabbing houses once they bought it. Home builders now seeing demand, starting to build quickly, and the tools are going to go like bananas. So that's that. The other thing that we rarely talk about is the percentile rank of the different multiples relative to their history. And you can see that basically on and on earnings, when you have negative earnings, obviously your PE multiple is going to be at the high end. And that's where people get messed up during downturns, is because they write down, they kitchen sink everything. So earnings are really, really, really low relative to the normalized trend line. So you wind up with like an 80 times PE, and people are like, I'm not buying a stock at 80 times earnings. Well, that's aberrational earnings, kitchen sink quarter or year earnings, restructuring earnings. And when you get back to trend, the multiple drops from like 88 to like 10 in like one quarter, and people go, what happened? But you can see that more clearly when you look at price to sales, price to book, price to free cash flow, EV to sales, etc. You can see these are in the lower decile of historic multiples, and we're going to see those accelerate. The other thing that many people are missing here, you get a 3.63% yield while you wait, and that dividend has been growing every single year for decades. And it's been compounding every year at 4.98% for the last 10 years. So not only will you be buying the stock, you do whatever you want, by the way. As we always say, opinion, not advice. Do your own homework. Contact your financial advisor. Go to hedgefundtips.com. Click on terms. We're going to have a new disclaimer at the end of the podcast today with some cool music. So definitely read that as well. You're locking it in here. You can see near historic highest yield, plus you get a compound growth of that yield, plus you get a stock that is 60% off of its all-time high. And what's most interesting about this story, I summed up in this last paragraph. Here are the three things you need to know about Stanley Black & Decker restructuring plan. $2 billion of cost cuts and return to 35% gross margin that started in 2023. I think they announced it in 2022. Number one, it's ahead of schedule. They will hit $1.5 billion in cut run rate in 2024 and $2 billion in 2025. Number two, $2 billion savings across 151 million shares equals $13.25 per share. The average historic multiple in this stock is 16 times. So excluding a re-acceleration of revenues, which will come, we think sooner than most, they will accrete $212 of share of value through cost savings alone. And as business normalizes, it could be worth a lot more. And that's something that people are not putting into their calculations. That $13.25 of cost cuts is huge as we get back to a normalized multiple, as revenues start to reaccelerate and the game is back on. So, we only get into stocks we believe can be a double plus. It's already started to move, but there's a lot more to go. And you got to take the long view. They are ahead of schedule to return to gross margin of 35%. The last time they were at this level was 2017 to 2018 period, when they earned $8.05 a share on 18% less revenues than they have today. So everyone's saying, oh, the revenues aren't doing anything. Well, they're 18% more than they were in 2017 and 2018 when they earned $8 a share and you had $153 stock. I think the stock is only $90 right now. So just on that basis, with 20% more revenues, they get the margins back, they got the cost cuts in. Forget about reacceleration, forget about all the candy they're talking about. This thing will move, and it'll do it in due course. So you can see the historic gross margin. We like covering that. Retail sentiment to the general market here is giddy. 51% bullish is at the top end of the range. 21% bearish is at the bottom end of the range. So all the bears are gone. All the bulls are in full force on the retail side. You see it also on the fear and greed index is getting up there. Probably got into the 80s today. And the National Association of Active Investment Managers, everyone has been chasing this rally up that we were excited about in October, and they're now excited about in March. So I think it's a little long in the tooth. Moving forward, earnings, top 30 weights of the oil and gas equipment services ETF XES. Their earnings have been revised down. Top 30 weights in the last 60 days have been revised down 13.9% for this year and 10.7%. That's a big downward revision. That's why we've generally steered clear of many of the oil and gas names we didn't feel had come down, with the exception of some of the natural gas names, which seem to have bottomed late in February. The one we really like here, obviously we still own some range from all the way back when, which we've talked about, from $4.10. But Commodore Resources is a new position recently that we've just been leaning into. So we are, so that's that. And then the second one is ARK, top 30 weights, the Cathie Wood ETF. The cumulative earnings power of these stocks has fallen by 19.34% in the last 60 days, and for next year down by 11%. So, there's some things going on under the surface that made me want to raise some cash, take some profits, put on some tactical shorts, and then the things that are still way below value, keep fully invested. And that's exactly what we did. Earnings still look strong for next year and the year after. So that's all fine, which is why we're bullish long-term, constructive long-term. Some of the economic data, jolts are still came in a little bit better than expected. Continuing claims was higher than expected. So that kind of bodes well, but initial jobless claims came in line with expectations. That's starting to move up. So there will be enough things to start to give the Fed cover to do what they need to do. The key is whether they get enough cover in enough time, because as I've continued to say, the earlier they start cuts, the less they'll have to do. For instance, if they did a cut in March, which they won't, they may only have to do 1 or 2 cuts for the entire cycle. That would be it. They'll probably wait till May or June, but then they run into the political risk, which they're going to do it anyway, but the optics are going to be very, very strange for them. But leaving that aside, let's move to the Ask Me Anything questions. Hey, Tom, by the way, for everyone else, if you don't want to stay for the Ask Me Anything, thank you for tuning in. We'll be back next week, same time. Well, probably same time. I'm not sure. I'll be doing it from London, different place, same camera. And for everyone else that wants to stick around for the Ask Me Anything, here we go. Paul Falcone writes, just to follow up on AMN, it's a healthcare staffing company. Yeah, I didn't like this business for a reason. Let me just see here if I can give you any more color. Yeah, I mean, revenues and free cash flow were declining. But let's just have a look here. I mean, at some price it'll be interesting, but I don't love the staffing businesses. The recruiting Hendrick and Struggles or whatever they are. I mean, that thing had an incredible return on capital for ages and a good quality business, and the stock just didn't perform for the longest of time. It's kind of like the consultant businesses. I just have a hard time understanding what I'm buying. There's nothing tangible. Let's take a look here at the financials. Yeah, so revenues have really fallen off. I mean, from 5.2 down to 3.7. To me, that's not in 1 year. That's not like an ideal. That's down 27% in 1 year. That's not like a business that I feel comfortable with, where the revenues can fall that fast. I understand they got accelerated from COVID. Let's just see. Let's see what they did with their share count. Okay, they bought in shares at the right time. That's a good sign. Cash flow. Free cash flow cut in half, but it's back to trend. So it looks like 2002 was kind of an aberration. It priced that in. Now it's back to trend. Yeah, I definitely see your thoughts here. Let me just see. You added a few points. Dropped on a number. Revenue is normalizing from the kind of down 55. Yes. CEO bought $1 million worth of stock on February 27th. CFO bought a little. Yeah, I mean, this one might be okay. I would definitely listen to the calls and understand like what kind of it was that aberrational that COVID, the revenues rose and dropped just so much. Let me just see if these. You have to be careful with insider buying because sometimes they're just transferring it to a trust for tax reasons. AMN. I am not seeing this $1 million purchase you're talking about. All right, here it is. All right, Chief Executive Officer, February 27th. So you look here. Weighted average price. Okay, so this is a direct acquisition. He actually pulled out his checkbook and wrote a check. That is a good sign, Paul. Nice work on that. Let's see, the CFO. Yeah, this is a checkbook purchase. This is clean. This is not transferring to a trust for a tax loss. So yeah, a lot of buying here. I think you got something here, Paul. I would pursue it further. Just do the work, get on all the conference calls, read the annual report, see what their competition is. Do they have a moat? You probably have a decent margin of safety. It'll take a couple years to work its way back, but you may have a decent business here. If you can get it a little lower, that would be great. In the 50s is better, or low 50s would be nice. I don't know if you'll get it or you won't, but I think you're in the neighborhood, and just be prepared if it drops down to 40 to buy more. But this one's worth putting in the work. It's not for me, but I can definitely see the case for it. Good work. Bob Johnson sharing a famous quote from John Templeton: "Bull markets are born in pessimism, grow in skepticism, mature on optimism, and die in euphoria." There's been talk that if Jay Powell does not lower rates by May, that he won't be able to until December. Yeah, that's false. He's going to do it anyway. There's historical precedence where in 2016, the Fed did not touch rates until December of the year after the election. Now, that's all nonsense, Bob. This guy, my guess is he doesn't want to work for someone who, basically every day tried to fire him and publicly berate him on Twitter. So if anything, I think this would be his, retribution for what he thinks he went through in the past with the former president. And my guess is he'd be happy to do three cuts right into the election. But I don't think it will impact as it has historically, but that's a good data point that I don't think will apply this year. Johannes Jensen, what do you think about Paramount? Look, this one we've covered 1 million times. Eventually they'll get a deal done, but the scuttlebutt is that they haven't been able to get a deal done at all. No one really wants it, and the ask has been ridiculous, and it's a melting ice cube. I would say that someone will buy it. The question is at what price. Let me just see. This might be over leveraged already. That's why no one's come in. If I'm not mistaken, that's correct. Revenues have cut in half. They're down 75% since 2020. I'm sorry. What the heck? Oh, maybe that was the cash flow statement. Okay, this is the income statement. Let's just see. No, revenues are fine. See what they've done to the share count. Share count's generally okay. Cash flow. I mean, they have positive free cash flow, but it's de minimis, 150. How much debt? What does their balance sheet look like? Balance sheet, they've got almost $15 billion of debt and $2 billion of cash. I mean, that's the key issue. Yeah, total capital, $40 billion. And what's the earnings power of this thing? 140 million of free cash. Earnings are negative. I don't know. I think they're going to have to break it up and sell it piece by piece. I think it's a trade. You're waiting for a headline of a buyer stepping in at 20 or 25 bucks. I don't think it's going to go for much more than that. It's a lot of, also have to look at the debt when it matures. That could be another problem. I think you're probably good for a trade, but rule number one, don't lose money. Rule number two, don't forget rule number one. You have to do a lot of work. I would just stay away. You're just looking at price. You got to look at the value, and it'll pop, but this more likely than not towards the end of the year, once they cut rate and risk appetite comes back. So you're going to be holding it more likely than not for a while. New listener, can you tell me your thoughts on TG Therapeutics? I never buy individual biotech companies. We own a big basket, the XBIN equivalent. So that's starting to take off. But I have no edge on individual biotech companies. I'll take a quick look just at the financials, but I'd have to understand their technology. TX. Biopharma, medical diseases, multiple sclerosis. Yeah, look, they could have a miracle drug and it could fly, but I'll tell you, without even opening the income statement, I guarantee you they've been issuing shares until the cows come home. Let's just see how bad they've screwed their owners. Let's see here. Yeah, so they've gone from 45 million shares to 145 million shares. So they could cure the world of cancer, and by the time they do that, there'll be 1 billion shares outstanding, and it'll be a 10-cent stock. I mean, look, with all these biotechs, the sooner they cure cancer, the better, because all they do is raise money and dilute owners, which is why you need a basket, because you're basically buying a bunch of lottery tickets. Could this one be one of those lottery tickets that's a 10-bagger and they announce some phase 3 thing? Absolutely, but I have zero edge on that, so that's why I never buy these small individual biotech companies on their own. So I'll leave it at that. Maybe you can do more comprehensive work, but that's a tough game. Luka Bondanovic, I know you like companies with a longer history, but could you look over Coupang for me? I've added a couple times in the past year, growing at... Yeah, so this is basically the Amazon of Korea. I like this company. The reason I'm not involved in it is because it's going to trade exactly like Amazon and Alibaba and Sea and all these others. So it's just too much of the same exposure. But yeah, this one's an absolute winner. Yeah, it's. I think you're going to be fine with this one, but it would just be too much overlap for me, and I'm actually more bullish on China for the next 3 years than I am on Korea. But this is going to work, in my view. Good work, by the way, Luca. Lars Siekel, you looked at OEM suppliers and chose Cooper Standard, sniffed around this area. Many of the other suppliers look cheap. shift towards zonal car architecture where the electronics is handled by fewer, more powerful control units. Should bring some tailwinds like Aptiv. Yeah, let's see. Let me pull up. There are a lot of cheap ones. I've looked at BorgWarner and all the others. This one was the most operating leverage I could find. It met the exact criteria that Tenneco did when Munger did that one in 2001. And I just copied success. It's pretty simple. Let's just take a look at Aptiv. All right. Yeah, I think this one is probably okay. And there are a few of them. Yeah, I mean, look, I think you're right about the whole group. The key is you're not going to have a 10 bagger from here. I probably, well, from these levels now, I'll probably have, from the original levels, I'll have way more than a 10 bagger. I think I'll have a 15 or 20 bagger from our basis. With this one, you know, you get a double from your basis, which is a great thing. And this would be something that we would look at for as a potential portfolio holding if we didn't have so much exposure to Cooper based on how much it's grown since our original basis. So good work. Paul Falcone asks, hey, Tom, very important question here. How does your golf game look as we enter the golf season? How's that putter working for you? I'm pretty confident, to be honest with you. I'm going to be going to Florida the first week of April for a few days. Plan to play with some folks down there, friends of mine, and also got the simulator set up in the house this winter. So I've been hitting every night and push draw, push draw, push draw. I mean, it's coming together. I don't want to get too excited until I translate it out on the golf course, but the machine is working. The putter feels good. I got to work on distance and speed control, but the line has been great. And pretty confident. Look, last year was my second season. I broke 40 a few times, never pulled it together to break 80. Most backs were a disaster after I broke 40. So, first goal is to break 80 once. If I can do that, it's a win. If I can do it more than once, it's beyond any expectations I had when I started 2 years ago. So, I'd be happy for life in that range. And just enjoying it, getting exercise, being with great people. That's the key. Diego Paliz, I'm a small investor, hoping to become a client someday. Grateful to have you. When you're ready, you'll do it. Just do the work and learn, and you'll get there. Been listening to your podcast. I have my stock allocations done, and my stocks have gone up. I do not want to add to those positions. What do you do with extra cash when everything has moved up? Just thinking of buying some kind of dividend ETF or bond ETF. It's not as volatile as stock, or just keep cash. What do you think of BMY? Sometimes when everything's up, you can just keep cash and wait for a pullback, or raise cash and wait for a pullback. But there are things to do. BMY I looked at a couple times. I think it's generally okay. It's not a world beater or anything, but I think at these levels, you're probably okay. I don't know the pipeline backwards and forwards, but just cursory look at the financials earlier last week. I thought it looked okay. Not good enough for me to get involved, but interesting enough and hated enough that I think you'll do okay with that one. So with that said, I want to thank everyone for tuning in this week. We will be back next week, same time, different place. In the meantime, make it a great one. And now to our new disclaimer. Let me know what you think of the new music in the comments below. If you like this, please, what do they say? Like and subscribe, and we'll see you soon. A great one. Bye for now.